In this video, we'll be discussing the status of the U.S. economy going into 2025. We need to make an objective assessment using hard data released by the government when making this assessment. My short form verdict is that the economy is in a good place currently, with inflation subdued and with real GDP growth moving above a 2% annual rate. Job growth has remained solid through this year, with 1 month being negatively impacted by strikes. The annual increase in average hourly earnings is significantly above the annual increase in personal consumption expenditure inflation. The average annual wage increase through November of 2024 was reported by the Bureau of Labor Statistics as at 4%, with PCE inflation reported yesterday at 2.4%. GDP simply stands for gross domestic product, and it reflects all goods and services produced by the economy and is a broad measure of the U.S. economy's health. Real GDP adjusts the nominal number down by inflation. The government released last week its third estimate of third quarter real GDP growth. The estimate increased to a 3.1% annualized growth rate, up from 2.8% in the prior estimate. When the Fed released its economic projections last week, it increased the projected 2024 real GDP growth rate to 2.5%, up from 2% estimated in its September projections. The Atlanta Fed's GDP model currently forecasts fourth quarter real GDP growth at 3.1% as of 12/20/2024. Given the size of the U.S. economy, annual real GDP growth in the 2 to 2.5% range is optimal, in my opinion. Higher numbers will occur coming out of a recession, with 2021 being the latest example, where real GDP growth was at 5.8%, but that was coming off 2020 when there was a negative 2.2% number. The November PCE inflation report released yesterday was slightly better than expected, and that caused a decline in interest rates, resulting in both a bond and stock market rally on Friday, December 20, 2024. The key to the PCE inflation report from the perspective of both the bond and stock investors was that the month-to-month increase in both PCE inflation and core PCE inflation was only 0.1%. The annual PCE inflation for the 12-month period ending in November was reported at 2.4%, with core PCE inflation at 2.8%. If the low month-to-month number persists for a few more months, PCE inflation will retreat to 2%. One non-expense that is heavily weighted in PCE inflation and the CPI numbers is owner's equivalent rent, which has started to come down. This pretend expense assumes that homeowners pay rent to themselves for living in their home that they own. I discussed this major contributor to inflation numbers in a prior video, and we'll link it in the More section below. Well, Trump is constantly claiming and characterizing the U.S. as a failing nation that only he can save. The truth is that the U.S. economy has been and is now and will likely continue to be the envy of the world, with or without Donald Trump as president. Also discussed in my last post published on Thursday the increase in intermediate and longer term rates that has coincided with the Fed rate cuts. They started on September 18th, I think it was, with a 50 basis point cut and then another 25 basis point cut in early November and a 25 basis point cut again in last week. The Fed can control short-term rates like the Treasury bills, which have come down a lot during this rate cutting process, through changes in the federal funds rate, but needs to use quantitative easing, QE, to influence the longer-term rates. History has proven that the Fed can effectively suppress the 10-year Treasury yield below the inflation rate for an extended period of time through monetary policy measures. QE involves the creation of money that is then used by the Fed to buy treasuries and mortgage-backed securities. This will influence the rates for those longer-term securities. Through QE, the Fed balance sheet ballooned to over $7 trillion by March of 2022. The Fed's excessive money creation and maintaining its stimulus monetary policies, both QE and ZIRP, throughout 2021 and 2022 were a major contributor to the problematic inflation numbers experienced during that period. Since the Fed has ended QE and it's allowing its securities purchased with newly created money to run off, it is no longer suppressing the longer-term yields, and those are consequently determined more now by market forces, including what I would call a normal 2% to 2.5% spread to the annual inflation rate expected for the next 10 years when pricing a 10-year nominal Treasury yield, which is close to where it is now. When the spread moves close to 2.5%, that will often reflect some concern that the anticipated inflation rate priced into the break-even inflation rate for the tips may end up being too low. The 10-year Treasury yield closed last Friday at 4.52% with a 10-year break-even inflation rate for the 10-year tip at 2.29%. The spread to the projected inflation rate was consequently 2.23%, close to the middle of the 2%, 2.5% spread that I consider to be normal. But the higher than 2% indicates some concern that the average inflation rate prediction of 2.29% may end up being too low. So about a 0.25% is added to a normal 2% spread to account for that risk. I believe this kind of calculation is at least relevant to me, to many of my portfolio allocation decisions, but perhaps is the most pertinent to whether I buy a 10-year nominal Treasury, non-inflation protected Treasury, or the 10-year tip, whether one or the other would be a better buy because of the inflation prediction embedded in the 10-year tip break-even inflation rate. Not that either one is good or bad, but whether one is more likely to produce a greater total return over the next 10 years than the other. I did participate in the 5-year Treasury tip auction that was held last week.